Welcome back to Investing Talk Podcast, and we wish you a Happy New Year and a good 2026 ahead.
Today we're looking at NIO.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. I think we have to start with the sheer magnitude of their Q4 2025 performance guidance.
It's pretty massive.
It is. The company is expecting to deliver between 120,000 and 125,000 vehicles. And that isn't just, simple growth. It feels like a real step function change.
A huge year-over-year increase. It signals that maybe, just maybe, scale is finally hitting that critical mass they've needed for so long.
Exactly. It's what this kind of capital-intensive business model was built for.
Okay, so let's unpack the financial side of that volume, because, volume by itself doesn't tell the whole story.
Sure.
That delivery range, the 120 to 125,000, that translates into projected revenues of somewhere between $4.6 and $4.78 billion.
Right.
But for us, I think the real story isn't just that final number. It's the momentum within the quarter. October was the first time they ever broke 40,000 vehicles in a single month.
And that kind of pace, it shows that the expansion, with the new brands like Onvo and Firefly, is already paying off immediately.
Yeah, generating tangible results.
And that monthly momentum is so crucial. It lets them leverage all those fixed infrastructure costs. But what's really compelling to me is that while Onvo and Firefly are the volume engine, the premium core is holding strong.
You're talking about the ES8.
Exactly. The third-gen ES8 hit its 40,000th delivery just 100 days after it launched. That success in the premium segment, vehicles over that RMB 300,000 mark, it provides a really necessary anchor.
So it maintains the brand prestige while they dive into the mass market. That's a tricky balancing act.
It is, but it's showing up where it matters most.
In the margins.
In the margins. Gross margins hit a 3-year high of 13.9% in Q3, and vehicle margins were even a bit better, at 14.7%.
And in an industry that is just locked in these brutal price wars, a 14.7% vehicle margin.
Yeah.
That signals they are getting very close to that magic inflection point.
The break-even point, where every extra car actually contributes to the bottom line. And it's not luck either. It's aggressive cost discipline.
Right. The supply chain moves.
They made a really tactical shift. They increased their reliance on CATL for batteries and suspended some of the smaller, less efficient suppliers.
For you, the listener, connecting the dots here, optimizing that supply chain is probably the single most important thing they can do right now to go from just a growth story to a profitable car company.
Absolutely.
So they're selling huge volume, margins are rising. But here's the critical question. What stops a rival like Tesla or, a domestic powerhouse like BYD from just crushing them on price? What's the moat here that protects those margins?
That is the perfect pivot to their competitive moat. And it is, without a doubt, the battery swap network best.
This is their core differentiator.
It is. They're operating over 3,655 stations across China. And that's not just a number. It's a proprietary integrated ecosystem.
And let's just take a moment to really appreciate the strategy behind BOSS. It fundamentally changes what it means to own one of their cars. You eliminate the two biggest pain points for any standard EV owner: range anxiety and battery degradation.
Exactly. This infrastructure creates really high switching costs. Your competitors who just have fixed batteries, they can't replicate this.
Right.
Think about it from the consumer's point of view. Once you're in the BOSS ecosystem, you get a fresh battery in, 5 minutes? Faster than pumping gas. Why would you ever go back to waiting an hour at a charging station?
And that's what protects their 20% market share in that premium segment. Without that 5-minute swap, I think they'd be way more exposed to the price wars.
Yeah, for sure. And what's fascinating is how government policy is actually giving a tailwind to this specific strategy.
Not just generic EV adoption.
No. Specific subsidies, like that 20,000 yuan trade-in program, they explicitly favor smart battery swappable models because you can sell the car without the battery, the upfront sticker price drops.
It's a massive incentive for the consumer, and it's enabled directly by policy.
And this is where the business model gets really interesting. That physical infrastructure, the stations, it converts directly into high-margin recurring revenue.
They're getting close to 100 million total swaps.
100 million. It's a staggering number. And just to give you an idea of the density, 10.4 million of those swaps happen in Shanghai alone. So every car they sell, they're basically signing up a new customer to a service contract.
Okay, that's a powerful story. But now we have to talk about the elephant in the room.
Financial health.
All of that amazing infrastructure?
Yeah.
It wasn't cheap. I mean, that is a massive capital outlay.
That's the painful part of building a moat, right? The company has racked up around $20 billion in historical losses, mostly from that heavy investment.
And analysts have noted, shrinking financial flexibility. That's a real concern.
It is, but that Q4 scale we talked about is the necessary antidote. You need that massive revenue to start managing the debt and the pressure on cash flow. The market is betting they're at the inflection point where scale finally tips the balance.
But is there a realistic time frame for becoming free cash flow positive? Or is this just a continuous capital burn? How are they managing that CapEx?
Well, that's where the investment into Mirador comes in. They're putting a billion RMB into this infrastructure operator that actually manages the Bay ecosystem.
So it's a strategic pivot.
It's a pivot to become more asset-light. They're turning the infrastructure from a capital drain into a viable, securitizable asset. It solidifies BAS as its own thing, which protects the core car manufacturing business.
And that connects directly to the sub-brands. Onvo with the L60 model and Firefly.
Another move to manage capital and brand identity. They need the volume, the 120,000 plus deliveries, but they can't get that just by selling premium SUVs.
Right, because if they push cheaper models under the main brand, they dilute the whole luxury position.
Precisely. So by segmenting the market with Onvo and Firefly, they can chase that aggressive volume growth without sacrificing the pricing power of their core line. It's smart.
Okay, let's pivot to the stock itself, the technicals. Because for all this great fundamental news, the stock has been a real roller coaster.
It definitely has.
It surged 4.7% on that Q4 guidance, but then it just reversed sharply, dropping 8.9%. Now it's sitting around $5.10. That kind of whipsaw action is tough.
It is, but some analysts are seeing that dip as a constructive pullback. That 8.9% drop probably flushed out the weak hands, setting the stage for more accumulation by longer-term investors. The volatility is just baked in right now.
And technically, there are some signs that momentum is building under the surface. We've seen some pre-market activities suggesting hidden bullish divergence. For those who aren't staring at charts all day, what does it actually mean?
It basically indicates quiet strength. It means that even as the stock price dropped, the underlying momentum, measured by something like the RSI, actually started moving higher. In plain English, it suggests that buying pressure is building quietly and that the dip might be ending.
And looking ahead, if these delivery trends continue into 2026, there's talk of a potential golden cross setup. Why is that specific indicator so important?
The golden cross is a big one. It's a classic bullish signal. It's when the short-term moving average, like the 50-day, crosses above the long-term 200-day. Institutions watch this because it suggests a real lasting shift in the trend from bearish to bullish.
So it confirms the fundamental story is translating into sustained price action.
Exactly. And this technical setup has some serious macro tailwinds behind it.
Shanghai extending free EV plates into 2026 is a big one. The cost of a standard plate there is immense, so making the EV one free is a huge economic incentive.
It really is. And that domestic strength is being matched by international expansion. China's overall EV exports are up, 87% year over year? That dynamic is lifting the entire sector.
Okay, so we've laid out the bull case pretty clearly. The scale, the moat, the technicals. But where do we start poking holes in this? What keeps you up at night here?
Number one is always going to be the intense competition and the price wars.
BYD, Xiaomi.
Exactly. They're constantly lowering prices. It's a battleground. And even a healthy 14.7% margin can disappear very quickly if you're forced into a price war.
And the second risk goes back to that volatility we mentioned.
Yep. Demand visibility is still an issue. That sharp 8.9% drop just shows that any little execution risk or supply woe can still spook the market. They have to execute flawlessly on these new rollouts.
Flawlessly, especially with that $20 billion debt burden in the background.
Mm-hmm.
But despite those risks, there's some major catalysts coming up in the next 3 months.
Mm-hmm.
What should we be watching?
The biggest one is earnings. Q4 results are expected in early February or March. We already know the delivery numbers are strong, so the market is expecting a revenue beat.
So the focus will be less on the top line and more on the margins and guidance.
Absolutely. Any improvement in that margin profile will be seen as a huge, huge win. And then there's expansion.
Right, outside the mainland.
We're watching for Firefly launches in the UK and Thailand in the first half of the year. Entering Europe and Southeast Asia provides a vital new growth engine. Plus, the Onvo L60 ramp-up is fully underway now that they've secured that CATL supply.
Okay, finally, let's touch on the speculative rumor that could really change the whole story, the multiplier effect for Boss.
Yeah, this is the really interesting part. There's a lot of chatter that the 2026 subsidies could be structured to create a financial multiplier for Boss.
So every sale fuels that high-margin recurring swap revenue.
Precisely.
Right.
And that's why you're hearing people start to use the phrase Apple moment. It suggests a transition from being judged as just a volatile hardware maker to being seen as a high-margin services platform.
And if that happens, the entire valuation methodology changes.
Complete.
So the story here is fundamentally about scale finally hitting critical mass, leveraging an infrastructure moat that took, what, $20 billion to build. The combination of record Q4 delivery numbers and that unique battery-as-a-service network. It really does position them for a profitability inflection.
I think for you, the listener, the insight is this. The market is currently valuing the debt, that $20 billion build-out, much more heavily than the future cash flow potential of the mode itself. If they can execute and prove that BAS creates that Apple moment of subscription revenue, then the current volatility is simply the price of entry.
If this discussion gave you a new perspective on the EV landscape, let us know in the comments below, and subscribe to stay informed on our next analysis.